Hey guys, welcome back to the Capital Mindset Show. So today's video is kind of going to be unique. I promise if you stick to the end, you're going to learn something at least about index funds or ETFs. And the reason we're doing this as a unique video is it's going to be a reaction to one of my own videos. The reason why we're doing a reaction, not a redo of the video, is because for one, the title really sucked, so it didn't get really that much attention. But I think the value provided by this video is very important for people to kind of understand. It's not really talked about at all on YouTube. It's kind of well known within the, I guess, funds world, but not really a well-known fact in the, I guess, by retail. So this video will be there forever, you know, free information, etc., blah, blah, blah. And I'm doing a reaction because then I can probably listen to the things I stated and provide some more color here and there, as well as maybe some adjustments, because it was when I was newer to making videos. So I can shed a little bit more light on some things, kind of understand from where I can expand upon certain ideas, etc. So without further ado, we're going to start with this video. You can see the title of the video was terrible. So the title of this video should hopefully be better, and therefore should kind of reach a wider audience to kind of spread this information out. If you want to kind of help out, you can share this video with other people who you think would like to learn this. And then again, I'll shed some more light. Couple changes to the channel format. I had to be as descriptive as beginning, more or less. And this is from the years 1999 to 2000. Okay, so I'm going to summarize this part because this part is nothing that's really super important for understanding the rest of this video. But there's the benefits of index funds. Index funds have the benefit of psychology. Okay, so a lot of people, they have subpar returns over a long period of time. JP Morgan measured this, that the average investor makes about 2-ish% per year. Now, if you can actually see this here, I'll just use my own image, but 2% average investor, REITs have performed 9.9%, and that's up to 2018. The S&P has done about 5.6%. etc. So with that being said, and that's 1999 to 2018, that's mainly due to psychology. If you actually think about it, we've been talking about this even now. I think this is very pertinent even today. Look at some of the people we've talked about with regarding to investing as a story-driven investor or an analytical-driven investor, some of the extremes that you can have, emotional-driven investing, people buying into these companies with these stories, whether they're like these vegan food companies or some gaming company that has, you know, revenue that's most likely what's not. It's so obvious because so many other creators were talking about it, guys, so it's not like the information was like hidden. And then obviously now it's obvious to everyone because it showed up, but the revenue was kind of pulled forward. So all these things kind of contribute to the lackluster returns by the average investor, and why the average investor probably should just be invested in index funds, because they're not going to be able to distinguish a good company from a bad company, even if it hit them in the face. Unfortunately, that's the case, mostly due to psychology. So that's basically what I wanted to cover there, and we'll kind of skip over this. So then I'm going to go through this imagery fast. So another benefit is cost. So the cost structure, index versus a mutual fund or a hedge fund, it's much cheaper. And obviously, if you go something like Vanguard, which is one of the ones, you have Vanguard, BlackRock, but Vanguard is being the nonprofit in this instance, has oftentimes better or not sometimes equal costs relative to how much you spend when they manage your money through this index. Okay, so through the ETF, okay, exchange traded fund. The index is what it follows, but you got what I'm saying. So index funds tend to be cheaper, or ETFs tend to be cheaper regarding ETFs, index funds. Okay, ETFs, index funds. So moving forward, kind of just skipping through. It's also the third benefit. It's very easy, and so I'm skipping over this stuff because this isn't the meat and potatoes. So concern number one that's typically cited is dumb money. So if you read Mike Green's work, that's usually what's cited. So the amount of money that is passively managed versus actively managed. And this, I say, no, don't worry about this. No one should be worrying about this. Actually, if this is happening, you should rejoice. In fact, at work, we actually talk about this a lot. It actually increases the opportunity scale within the market. So before, it was perhaps a little bit harder. As money becomes more passive, if it does become more passive, that's actually a benefit, not even a concern at all. It does imply that the market will experience sometimes quick jumps of volatility, which I think we can see by 2018, 2020, and now 2021. It's kind of becoming more obvious than not. And, you know, I kind of suspect that 2021's rally will also be very sudden as well. But regardless, that's kind of just speculation. I'm just saying, if the concern is true, if you take Mike Green's word for his work, or of the various other works that exist out there, that this is happening, it's not necessarily a bad thing, okay? So And I think that's pretty much it. Those in my inner circle, those close to me, those take advantage of the drawdowns that are going to be caused by the ETFization.
Okay, so that's me talking about the ETFization.
What that means right now, and then I'll kind of talk about what some of the problems you guys might be thinking may arise from a market cap weighted strategy. All right, so essentially what it means is the larger the stock, the more it will add, okay? So remember that in the past, the dominance of the market was by individual investors, by what we call, again, for using the word, smart money. And so the passive investment strategy was simply that the market would dictate where capital would be allocated best, and then you should just follow the market, right? But now what happens when you become the marginal buyer? When dumb money becomes the marginal buyer, things get a little bit interesting on that strategy, right?
So I'm kind of referencing that previous concern, and as well as kind of highlighting further how indexes or these ETFs are designed. They're designed by market cap weighted indexes. So the philosophy behind it is that the market will determine over time which ones are the best companies, and that will happen by their market caps growing. Okay, so that's the philosophy behind it. So these index funds, they are organized as such. And so when the larger the market cap becomes, the more it becomes of the index. The smaller it becomes, the smaller it becomes of the index. That's how all of them typically work, except for the Dow Jones Industrial does not. That's a price-weighted index. So price-weighted index is really silly. You can look up what that is, but we're not talking about price-weighted indexes. We're only talking about the market cap-weighted indexes, which are the most popular. So think of VTI, VT, SPY, all of these. They're like that. Well, those are the ETFs, but the indexes, the SP 500 index, the total world index, et cetera.
Right? So that's some of the concerns you may think about. But anyway, for the most part, you can kind of see here, as Apple grows, right, the more it buys. So the more Apple grows in stock price, the more the index will buy. The more, and then for those of you who've been watching the channel for a long time, you know that the mechanism for how stocks go up in the short term is simply more buying than selling, right? It's the amount of buyers versus the amount of sellers, or the amount of buy orders versus the amount of sell orders.
Just want to kind of clarify that. So that's actually talking about, you probably heard from this, over the short term, the market is a voting mechanism, and the long term, it's a weighing mechanism. So that actually is why. Because mechanically, how stocks go up is there's more buying pressure than selling pressure, and then stocks go down in the short term because there's more selling pressure than buying pressure. Okay, so over the short term, anything can happen. Something can cause volatility to either direction, to the upside or to the downside. It could be sentiment driven, could be liquidity crunch, which is what we're going on now. So it's very rapid. Margin could be rising, so the velocity of margin could be rising drastically to the upside, and that's pushing a lot of money into stocks. And then you could have the reverse happening, which is the liquidity crunch, and then moving stocks to the downside. That could be happening. So all of this is separate from the fundamentals of a business. Then, of course, the fundamentals of a business could be changing drastically, in which case, over long periods of time, you should see that reflect that to the negative or to the positive.
And again, if the stock price keeps going up, right, what will there be more of from the index funds? More buy orders, right? So it's a self-fulfilling loop-de-loop process, which is rather interesting. And then in the opposite direction, if things start to sell off, it can accelerate the sell-off, right? So if certain sectors sell off, they can sell off harder than before. So it kind of, again, goes back to...
And by the way, I wanted to clarify that's on a relative basis. So if something sells off relative to the rest, because if everything sells off, let's say hypothetically, everything sells off by 10%, then the weighting isn't going to necessarily change, because in this perfect scenario world, everything sold off by 10%. But relative to each other, the weightings will change. If one sells off more than the other, then the weighting of the one that sold off more will decrease. Does that make sense? And comment down below if that doesn't make sense to you. But basically, in a relative basis, we have to be I wanted to clarify that here. And this is why we're doing a reaction, so I can clarify things, and you can kind of also get the value of this video as well.
To what I was saying before, I think there's going to be sharper drops and quicker rises, right? And I hope those of you watching probably have been observing that, right? Since about 2018, when the majority of the money started to slowly become dominated by index funds, you can kind of start to...
Want to clarify that too. It's not so much actually index funds that dominate, it's actually passive money, which actually is more expansive than just index funds. People don't know that. So I was thinking that in my mind, but I wasn't actually good at explaining that here. Again, still newer to making videos. So sometimes, and there was a lot to talk about, so I didn't go back and correct that. But so there's what we know as the typical index funds, which I think is still a minority of the market. But then on top of that, there are funds on top of that mirror the index funds. on top of that are kind of more actively managed, that people don't consider them, they're not counted for in the actual count for passive funds. So they actually end up becoming passive funds because they behave equal to that. And then once you count that, they actually count for a majority. I think even like just kind of quoting Mike Green. Mike Green, I think, is a little more aggressive in his estimates. He believes it's closer to like 60%. I don't think it's like that, but it could be. So it's between just over 50% and 60% is, I think, where the real number lies today, in terms of how much is actually kind of just passive. Okay. And I think, again, if you believe in concern number one, or whatever it was, number two, it's not a big problem for you if you really think about it. It should actually be to your benefit, because most of the money is going to be not paying attention to what the fundamentals are doing of the business, if that is the concern that actually plays out. So that's why my claim to that was it's not really a concern. Okay.
See that happening in the market. And I think this is a good thing for the individual stock picker, not a bad thing.
Okay, so I'm repeating myself there.
It's actually, in my opinion,
all right,
going to be easier. And here we go. So this, I want everyone to remember this number. Okay. So the number I want you to remember is 20.8. Okay. So S&P 500, 20.8. Okay. So it's around there. It's around 20 something. And this is fairly recent. Okay. So from here, again, please memorize that number and don't forget that number. We're going to come back to this. We're going to go to now a little bit of the breakdown of the meta, right? So I want to walk you through. I have to be careful how I walk you guys through this, but for the most part, should be fairly easy. And again, I'll try to be as descriptive as possible.
I want to pause here and just say, if you guys made through this whole video, you guys are champs. This is 30 minutes with no chapters. And I understand when things get physical, and like, I can tell I was working late that day. So, because when my voice is like monotone like that, I've been working a lot. So I'm just like, yeah. So, because I'm already mentally drained and I'm trying to explain the background of index funds.
Those of you who are listening to audio only. So here before you, I recreated a model portfolio, model ETF. For those of you who may see, yes, there's Tattooed Chef in there. Yes, there's Corsair in there. Those are kind of just shout outs, right?
When their market caps are that big, by the way.
All right. So anyway, the point here is we have Apple, Tesla, Microsoft, Google, Amazon, Tattooed Chef, and Corsair. Okay. Simply put, in year zero, these are the years up here. In year zero, we're going to take the market cap, right, of each company. And that's right here. Boom, 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 boom. All right. We add them all up together, right there. Okay. So in this example, okay, we're going to apply some random growth rates. And I literally just did it randomly. And I can change this if you want. So like, I'll change that back to 50. And there's a reason why I did that. It's for the presentation for an example. But right now, let's assume these are the growth rates. And I made them all positive because I didn't want to make any negative. Of course, some of those might be negative, but for the most part, they're all positive, and I wanted to showcase something. So down here, it's important to note the totality of the market caps, right? Because this is how, again, we're going to design our ETFs. The rules are that it's a market cap weighted ETF, right? So basically, in year zero, the weightings are as follows. Apple is 41.7%. Tesla is 14.92%. Microsoft is 34.99%. Google 27%. Amazon 22%. Tattooed Chef is 0.02%. Corsair is 0.03%. Okay, so this is our little ETF. And as the growth rates are applied by each and every single year, we see that the weightings change, right? Because some grow more than others, right? So again, the theory is that if you're doing a market cap weighting, you're going to adjust to those that are the market is allocating more capital to. And this is the passive investing approach, right? This is how all of them are designed. This is how VT is designed, VTI is designed, VOO is designed, all of them. Very simple, right? And you might then think, okay, well, if the rules were designed by humans, there's some flaws in them. It's like, yes. And then we'll kind of get a little bit more to that. So let me actually look to see in the sheet because I wanted to hide something from you guys and then kind of pull it up as a surprise. Yeah. Okay. Now it's hidden. All right. I almost spoiled something. All right. So now we're going to look at the PE concept, right? I know that in this channel, I've spoken about how GAAP net income, you got to kind of be careful with that, but we're going off the industry average. And remember, we're comparing it to that number we saw in Yahoo. And hopefully you guys remember that number. It's about, I'll say it out loud. It's about 20 something. So right here, we're taking the PE, and logically, how normally you use math to calculate the PE of something is by taking the weighted average PE. That's logically how you would do it. So you say, okay, if something is 20% of the index, it should contribute 20% of the PE, right? That's kind of like the logic, right? And that's how I would do it. That's how most people who know math, when I asked my brother, who is a mathematician, he said that's how he would do it. Yeah, it makes sense, right?
And it's to keep it simple, okay? Because sometimes the KISS model is good, but sometimes in finance, the finance guys, I'll just tell you that, and I can say that because when I study finance, it's something an old professor used to tell me, that finance guys like to overcomplicate things sometimes to make themselves useful, okay? So this is a good example, what we'll get to in a second.
Of course, you want to maybe sometimes eliminate anomalies, but for the most part, not really. You want to actually, if you want a real representation of what it is, there you go. And the reason why you want to eliminate some anomalies, let me explain that, because some of you may be like, what? The reason why is, some accounting discrepancies might change, one-time things, etc. So sometimes you want to eliminate those anomalies because you just so happen to eliminate those. Okay.
True. Agree.
But the point is, we would do a weighted average.
I agree with myself, you see.
PE. And that would give us about 88.96 for our portfolio. Because the PE is right here, you can see Apple, Tesla, of course. At Tesla being a 14.92% gives us a huge skew on our PE, right? So it's probably shifting us a lot. But even then, we have a lot of companies in here with very high PEs. And I just took what Google says is their PE, okay? This is not an analysis video, so I'm not going to dive deep into the numbers. This is just taking the PE, and we're trying to come up with an example. Okay, what if I told you this is not how they calculate the PE on index funds? I'll let that sink in 2 seconds. 1, 2. Okay. So yes, this is not how they calculate the PE ratios of index funds. Okay. I promise you, this is now where the math starts to get interesting. So what we have is, and you can see down here in the title, it's the harmonic average. Okay. This is how we collect the PE of index funds. Okay. When I say we, it's not me. I don't do it. Those who work in the finance industry who design these products, this is how they more or less do it. All right. So, and we'll get to the real world example of, we will calculate together the harmonic average PE of the S&P 500. But first, I'm going to explain to you how to calculate the harmonic average. And then you're going to probably, I don't know, some of you, your heads might explode because you'll be like, that makes no sense. Why do they do that? Okay, we'll explain. All right, so here's what I was trying to hide from you. There's no rule 3. I was going to write a rule 3, but there's no rule 3. So rule 1, no negative PEs. You eliminate those. Those are gone. Okay, so all the unprofitable, crappy companies, they're gone. Okay, rule number 2, no PEs over 100. For the sake of this example, I will not eliminate those. I will keep them in. I will use that in the real world example. I will eliminate the negatives and the PEs over 100. I'll filter them out, and I'll show you how I did that. All right. Anyways, for now, we're looking at the model ETF that I created just randomly. And by the way, I can switch whatever we want. Like I can say, okay, let's say we don't want Tattooed Chef. Let's say we want Visa. So, didn't mean to do that. Visa. Oh, no, not there.
Yeah, I'm so tired.
Visa. Or am I changing the wrong one? I am changing the wrong one. Let's actually escape. There we go. Okay, we don't want to change that one. These are the ones I want to change because those are all connected. All right, so now I just change it to Visa, and everything should be changing to Visa. The weighting's cool. All right, yeah, so everything's good. The weightings are good. All right. So now the PE has changed in accordance to that. It's a little bit about the same because it just got rid of a 60 and basically put a Visa, and Visa's been more in line, so it barely changed the PE. All right, but anyway, what you're here for, I just wanted to say I could change it, but there you go. A little fancy magic. All right. So the way we calculate
this should make you love math, because you can do so many things with math to just make things look different. Of course, well, logically, if you understand what the heck is going on, you'll be like, well, hold on, stop there. But to the average person, you'd explain this and you're like, this is what I'm going to do, blah, 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 and that's the answer. And they're going to be like, oh, yeah, whatever.
The harmonic average is actually quite interesting. So first you take the PE, the standard PE. You have your weightings, right? We don't care about those just yet, okay? So we take the reciprocal, okay, of the PE. the reciprocal in mathematics is simply 1 divided by the number that you're talking about. So the reciprocal of 28.95 is 1 divided by 28.95. And this gives you this number right here. So you see the formula, very simple, right? You get 0.034. All right. Then you add all these together and you get the sum. You get the total sum. Okay. Now, this one, I did this for as an example. So this is actually wrong. I need to do 1, 2, 3, 4, 5, 6, 7. So there's 7. So this one should be 7. And then we calculate it together. Okay. So now here, I'll explain how we got there. But you divide it by the number of stocks in your little ETF. And that's 7 in this case. So that's why we put 7. So you divide again. Let me say that again. You sum up the reciprocals, right? What is a reciprocal? A reciprocal is the number you're talking about. And then you do 1 divided by that number, right? Then you sum up those reciprocals, you get the total sum, and then you divide by how many stocks are in your ETF. And then you get that's what we call the average reciprocal, okay? So you divide the sum by the quantity, and then you get the sum or the average reciprocal, right? And then from there, you get the reciprocal of the average reciprocal, okay? And the reciprocal of the average reciprocal is 33.9. Okay, so this is the PE that we'll show everyone. This is welcome to the finance industry. So yeah, this is the PE that we'll tell everyone is the PE of our little ETF, not 86. Okay, because 33 sounds nicer. And technically, we did a bunch of fancy math to get there. Okay, and remember, we follow a couple rules: no negative P's and no P's over 100. I broke that rule here. Technically, I wouldn't even include Tesla's PE into the ETF. Wouldn't do it. Okay. Okay. So now, remember that number that we discussed, the 20 something from Yahoo or whatever. So now we're gonna discover what the S&P 500 is. All right. So I'm going to try, and I'm gonna pause here because I want to hide the number so we can kind of guess. Actually, I won't even pause. Let's just.
Right, we'll skip over.
Yeah. I already know it is exactly what they're showing you. All right, so I already went over how you calculate this. I just did it for every single stock in the S&P 500, filtered out, the negatives and the ones over 100. Eventually ended up with this, divided it by the number of stocks in the S&P 500. I got exactly what they offer you. There you go. That's how they do it. This is what, some might argue it should be. It should be 36 because that's the weighted average PE.
By the way, you might be wondering, the S&P 500 is more than 500. I only just took the 500. Yeah, sue me, bro. So I just took 500 because I didn't want to work with anymore. And so I just took 500 stocks. We got basically the same PE that's always cited by the ETF. The weighted average should be 36, actually, for the ETF at the time. This was on January 22, 2022. Interesting date there that it was posted. And so the weighted average is 36.4. Typically a lot of people would say that should be the PE, but the marketed PE is the reciprocal of the reciprocal, right? Well, the reciprocal of the average of the reciprocal. That's actually the PE that's always shown. So the PE at the time was 21.25. So if you remember the Yahoo Finance PE of the index, it was that. And I took all this number. This was public data. I just got the weighted average PE. That is the weighted average PE at the time. It was 36. And that's without eliminating the, I think that it might be with eliminating the anomalies, because there were some anomalies that were negative and positive. I think I eliminated the anomalies there. So I eliminated the negatives, and I just counted the positives, and I still got 36.4. And then the reciprocal one is how they standardize how they standardly calculate this. So the reciprocal of the average of the reciprocal. That's how it's done. And so, yeah, that's pretty much it. So if you guys have any questions on any of this stuff, it's really fascinating. I think a lot of people don't really know this. Again, this video was abysmal. I mean, I talked about it in the live stream, and I mentioned how it didn't get any views because look how terrible the title is. Looking behind the curtain index funds. It's even broken English too. So concept video series, complete boring. No one's going to click on that. And the thumbnail was even worse than that. So this thumbnail is probably hopefully going to be better. I'm going to make it like a little bit clickbaity in this instance because it has what I believe to be information that's not really talked about often. So I hope it provides some people some value out there. Some of you have already seen this video, so it's not going to provide you really much value except for the parts that I've kind of filled in and added some more information to. And there's going to be chapters in this one, thankfully. So it's going to be easier to digest. But let me see what else I had to say.
All right. They are a fantastic way to get exposure to investing. That is very true. They're, again, remember the benefits. They help you with your psychology of investing. They are low cost relative to traditional means. You may want to take my theory with a grain of salt because it's just simply my.
Okay, so kind of just closing off there because I think I'm just going to go on a ramble about the rest, but I've already covered the crux of it, and for some reason the ending is like a lot of credits, but whatever. So yeah, I think I've done a better job than there at kind of filling it in, kind of just avoiding some of the fluff in there. Now, I want to also add one more thing. So a lot of people cite the Shiller's PE, which is the Buffett indicator or whatever. So the problem with the Shiller's PE is it takes the GDP of the United States. And my issue with it is it kind of actually is a little bit misleading. And I might do a separate video for that, but I'll just leave you guys off with that. It is a very misleading indicator. It's not as useful as it once was. So a lot of people want to use it, and sure, it's like a good smell test a little bit, but it's not as reliable as you think it is. Just want to lay that out. If someone is using the Shiller's PE and you're watching this, please don't consider it as reliable as some of you or some people might have stated it as it is. It's not. There are particular reasons as to why it is. Let me know down in the comment section if you want me to make a video on that. These are more technical videos. So this video was just to tell you how it is that PEs on index funds, ETFs are calculated. Okay, and now you know. Okay, now you know that the PE you see, if it's ever cited, is not the real PE, and that's the marketed PE. Okay, if you really wanted to think about the real PE, a weighted PE, it'd probably look a lot worse. So, yeah, that's about it. All right, guys. On that note, thank you guys so much for watching, and I'll see you guys on the next one. Bye.